up downtown. Went up downtown. Went up downtown. I want to save my soul.
Okay, let me ask you a question real quick. What do you see in this chart at major highs and lows? Now, take a moment, pause the video here. Okay. You may have noticed these old highs being violated and a significant movement away from that. And we understand this as a turtle soup or a false breakout. It's important to understand that it's probably easy for you to see these in hindsight when I pick them out on the chart, but you probably don't have that much experience seeing them come to fruition beforehand. So in other words, you don't see them forming in advance. And it's because you haven't spent enough time going through the charts, seeing how they form over and over and over again. Now, obviously, you may not have noticed these. I'm pointing them out to you here. But for some of you that have been working with my content, maybe you've seen other ones. But these two here are the two majors. Okay, so you have two major false breaks above an old high, a nice false swing above a previous high, and then a rejection and a subsequent significant price swing lower. And then we have a false break below an old low, and we have a nice significant price rally higher. But let's take a closer look now. We have a old low here that's been violated. So the sell stops below that low has been ran out. So we would expect repricing on the upside, looking for buy side liquidity. The market trades above an old short-term high here, pairing up the buys from the previous low with buy stops they can sell to with a movement above a previous high. Each one of these is a turtle soup, the first being a turtle soup long, the second being a turtle soup sell. Down here we have an old low that's violated where sell stops have been ran out. We have an old low over here where sell stops have been ran out. We have an old high here where buy stops have been ran out. So you can see significant price swings at looking at the daily chart like this, and it gives you a great deal of prognostication when you anticipate every time a new high or low is formed, we expect some measure of rejection. That's the first anticipatory price skill set that you should be working towards developing, because it's the hardest one to groom in your trade psychology. Some of you probably understand that higher high failure swing and lower low failure swing, or turtle soup long and turtle soup buy. Some of you probably aren't aware that there are other distribution and accumulation patterns that take place at highs and lows. So let's take a look at that now. Okay, we're going to look at a bearish run on buy side liquidity, or a turtle soup sell. Now, obviously, when you look at this price action here, it should be pretty obvious after studying my material. We have equal highs that's been ran out. So there's buy stops above those equal highs in there that have been ran out here. We would reasonably expect to see what form? A sweep through and a potential rejection and trade lower. And that's what you would see here as an example. Now, some of you probably can see this relatively easy in the chart formations and how a previous high or a previous low has been violated, and then a subsequent rejection and a retracement of a longer magnitude. But I want to teach you tonight a different approach to looking at distribution and accumulation. Okay, look at this pattern here. Okay, we're going to talk about a bearish rejection block. And before we get into it, the ideal setups are found in major to intermediate term downtrends. And the bearish rejection block is when a price high has formed with long wicks on the high or highs. It can be more than one candle that forms a high of the candlestick or sticks, and price reaches up above the body of the candle or candles to run the buy side liquidity out before the price declines. As you can see, there are several wicks here forming potential resistance. Now, a classic chartist would look at this as a potential continuation pattern in the form of a bull flag. We taught earlier in this mentorship the falsehoods that come along with some of the classical chart patterns. Price does not move around because of animal patterns or supposed geometry in price action. It's based on the orders. Okay, and looking at this price action here, if this is near a overall longer term resistance level or trading into a bearish order block or an old low that may not be seen in this sample size of data, but as you can see, price has ran up higher for a good number of candles. Then it starts moving into a small consolidation. But more importantly, I want you to look real close. Is there a strong likelihood that this is going to go higher based on a continuation pattern of like a bull flag or a pennant? Or is it showing underlying distribution? Notice there's no higher high here. Or is there? Take notice of the highest body in this formation and the most recent candle that traded through it. Price pushes above the previous highest candle's body. Seen right here, that run above the highest body's candle produces the distribution seen in the chart here. Price does not need to make a higher high to have a failure swing. By looking at the bodies of the candle, which is one of the first things I taught when I started teaching online how the foreign exchange market operates, you don't need to have a great deal of understanding about candlesticks except for understanding where the open, high, low, and close is. And if you follow every swing high and low, and you chart the open, high, low, and close, and you deal specifically with the opens and closes, you'll be able to ferret out what distribution and accumulation takes place at these turning points. As you can see, the real pattern here is from this previous highest bodied candle, then the subsequent later higher drive higher. This candle here, prior to this candle moving up, this candle was the highest bodied candle. We're not paying so much attention to the wick. The wicks highlight the idea of this pattern forming. This pattern here, shooting above this previous body or previous close, this is the highest close or highest open in this swing high. This candle here drives above it, clearing out the buy side liquidity and then rejection. Basically, what we're seeing is distribution. So what is it really to see a rejection block, and what does it look like? I have a crude depiction here with a single wicked candle. Now this is going to be better understood when there is multiple candles that form the high and multiple wicks. You're still looking at the highest close or high. You're still looking for the highest open or close inside the swing high that forms. The wicks are just drawing your attention to a potential rejection block. When you see the wick, you have to build the parameters for the rejection block by finding the highest high and the highest open or close in the swing high. It does not matter if the highest candle is a bearish or bullish closed candle. You're still looking for the highest high with the highest open or closing price into the highest wick. That frames the rejection block. So once we have the rejection block defined by the highest wicks high and the highest open or close in the swing high, that frames the rejection block. And in your mind, you should be viewing it like we have here, a candle all in of itself. This range is going to be a selling block. In other words, we treat this as a bearish order block. When price trades back up to the low of that range, that is your trigger. Now you can do one of two things. One, if you're aggressive, you can sell at that price and put a significant stop loss above that particular price level. Or you can wait for it to trade through it a little bit, and I'll leave that up to you in terms of all the additional insights that we'll be sharing over the mentorship about entry patterns. Or you can wait for it to trade above that level, and if it moves a significant amount above that highest open or close, in this case is the highest close of that bullish green candle, if it trades above that particular level and it does not trade to a higher wick high, you could be a seller on a stop below that level. So that way you can be selling on weakness. This is one of the few times I use selling on a stop as an entry pattern. What it looks like in the charts, here's one example here. We have a candle with a wick. We use the highest body reference point being open or close. In this case, it's going to be the open. And price trades above it just a little bit, violates that, doesn't make a new higher high, and it makes a run eventually for the sell side liquidity below the marketplace there. So a rejection block for the bullish side of the marketplace is obviously in ideal scenarios, it's in major to intermediate term uptrends. And a bullish rejection block is when a price low has formed with a long wick or wicks. It could be formed over multiple candles. And the low or lows of the candlestick or candlesticks, again, it's not limited to just one candle. And price reaches down below the body of the candle to run the sell side liquidity out before price rallies higher. Again, we frame the rejection order block, in this case the bullish rejection order block. It's going to be the lowest wick low and the lowest open or the lowest close that makes that swing low on the time frame you're looking for the pattern. Once you identify that, you have framed the bullish rejection block, and we treat this as like a bullish order block. When price trades back down into the high of the block, we can be a buyer just below it, or we can wait for price to trade through it. If it's a little bit longer term time frame, we can wait for it to trade through it by a little bit, and then we can be a buyer on a stop just above that particular level here. Again, the trigger is that high or the lowest open or the lowest close in that swing low. But the key is it has to be a swing low that has a wick or wicks. In price action, this is what it looks like. Price makes a previous low with wicks. Market comes down, trades down just below the bodies of the candle, and then we see a strong rejection because of a massive accumulation that comes in. It's not always required to see a higher high for a failure swing, which would be a turtle soup sell, or requiring always a lower low for a rejection for a turtle soup long. We can anticipate levels like this to be taking profits at if we're short in this case. If the market had been trading in our favor on another type of setup, we could look at the take profit objectives to be covering the short just below the lowest open or close in the previous swing low. Don't always demand that price gets below the wicks. It's really the bodies of the candle that the closest thing to institutional understanding you're going to get when you're using retail price delivery mechanisms like the platforms we have to trade through from a retail perspective. Hopefully this has been insightful. We're going to be looking at the breaker. Okay, and what we're going to be looking at is how we can use this form of mitigation to highlight a trade setup. We're going to assume that we're watching price and it trades lower and creates a short-term low. Eventually, when that short-term low is violated and trades down into a support level, we view that initial drop down below the previous low as a potential false break or turtle soup long. Below short-term lows, there's going to be sell stops, and our expectation is we want to see if the market wants to get back above that short-term low. Initially, it may come up and flirt with that same old low and give an indication that it may want to view that as a resistance price point. We're more inclined to wait to see if it wants to show a real significant price move higher. Eventually, when we see that here, this is going to be in the form of a market structure shift. It takes out the high or the short-term high. That high is what we focus on. Wait for price to come back down into that old high. When it trades there, we view that as real support because there's going to be orders inside that high that will be looking to be mitigated. In other words, those individuals that were short at that high, they're going to want to take those positions off and maybe get in sync with a new leg higher in price. As price moves away, that confirms the breaker, and then we wait for higher objectives to be met in price action. Again, focusing on the high in between the two lower lows. One low has to be traded below. That's going to run out to sell stops. We focus our attention on the short-term high that's in between the two lows. We use that as a resistance level that's broken that will become support, making it a bullish breaker. Contrarianly, we can look at the market in this way. When the market trades higher and takes out an old high and then breaks below the low that makes that new high, our focus is there, and we view that as a bearish breaker. Okay, so take a closer look at a bearish breaker. Okay, a bearish breaker is a bearish range or down close candle in the most recent swing low prior to an old high being violated. The buyers that buy this low and later see this same swing low violated will look to mitigate the loss. When price returns back to the swing low, this is a bearish trade setup worth considering. So we have an old high here that's traded through and rejected. It runs the stops above the old high. Those buy stops are now neutralized. And we focus our attention on the swing low that formed between the two highs. We see a market structure break. retraces back to the swing low. That is the bearish breaker. We look for another low to form with a new leg and price moving lower. The salient points are what we're looking for is an old high to be ran out or a false break above an old high. This raid on buy stops indicate buyers are trapped long. We know this is true when the market quickly does a repricing, that's seen here. Repricing lower after buy stops are taken, that is a confirmation that we are potentially seeing a new breaker forming. The low that's violated here, once market structure is broken down, and all future retracements will be viewed as new selling opportunities, especially once it trades back up to the low here. That gives us our bearish breaker. Okay, for a bullish breaker, it's a bullish range or up close candle in the most recent swing high prior to an old low being violated. The sellers that sold this low and later see this same swing high violated will look to mitigate the loss. When price returns back to the swing high, this is a bullish trade setup worth considering. Again, we have an old low that's violated, taking out sell stops below that old low. Our swing high is where we're going to be looking for our bullish breaker. But we have to wait for price to break through that swing high to confirm that there has been a run on stops and that old swing high will house, or inside that swing high will reside, a bullish breaker. As price trades back down to that swing high, we would be buying that with the expectation that there is going to be a mitigation that's taking place. Those sell orders that they use to drive prices down below the old low, they would be underwater here or not making a profit. So they're going to want to take those off and add more longs. And that's our bullish breaker. And then we would expect to see and anticipate a range expansion to the upside. The telltale signs that you have a breaker in formation or confirmation. The raid on sell stops indicates sellers are trapped below the old low. The range expansion that takes out the short-term high in between the two lows. This repricing higher after sell stops are taken is a confirmation that the market is, in fact, a run on stops below an old low and the old high that's violated that supports a market structure shift for bullishness. This run here supports the market structure being broken higher, and any retracements from this point on will be viewed as a new buying opportunity when it trades back into the old swing high here. When we see that, that's a bullish breaker. So let's take a look at it in real price action. Okay, we have an old low here. The market trades down below that low and punches through it again and then rallies up. So what we're seeing here is that market structure shift after stops have been taken on the sell side. So there's been a massive repricing. So the market's going to want to look to reprice lower and retrace back down into what? Where's our focus point? We find the short-term high and the last up candle in between the two lows that most recently formed and taking out those sell stops. That's seen here. So right now, this would be viewed as a bullish breaker. We would anticipate seeing the market trade higher, where those orders would be collapsed once retraded back down to with price. Any selling orders would be mitigated and new buying orders would be replacing them. And there's the subsequent price actions you would anticipate seeing in your charts. So study your charts, look at examples where you see this formation, where you have the market creating a low and then the market trades down lower one more time and runs through the short-term high in between. This is where classic support ideas are effective. You've probably done what I've done as a new trader, where we look for support and resistance ideas by drawing a horizontal line, and you think that it's that easy. Well, you have to have a storyline behind why price is doing what it's doing. If you understand what the breaker is doing, it's indicating that it's running a stop pull of liquidity out. When you find the short-term low that's been violated, find the short-term high that this recently formed. When it trades back down to that, that will be in fact a support level that is highly probable for bullish prices. You see that here. It's trading inside the range that's created with this last up candle. Why am I using this one and not this one here? Because this one was the highest one prior to the drop down, and we're using the entire range. Price trades down into it, recapitalizes. All the selling they sold here that drove prices down to take these sell stops out. They're underwater or losing money here. They have deeper pockets than us. They'll wait for price to get back to an area where they can mitigate those shorts and add new longs, and that's why you see that explosive price action seen here. So
hopefully take a deep dive into that price action right there. All right, so we are looking inside that fair value gap on the daily chart. This was the high end of that fair value gap, and this was the low end of that fair value gap. The time frame on this chart, as you can see here, 1 hour, and I've outlined market structure in the idea of long-term high, long-term low, short-term high, short-term low, and in between those two swing points, there's an intermediate term high and an intermediate term low. When we look at price, we're not looking for just the simple higher high, higher low, therefore it's a bullish market or uptrend. That's not what I'm looking at. I'm looking at, does the market have a reason to go up for buy side liquidity or buy stops? Or is it likely to go up to rebalance an imbalance, which is like a fair value gap? Or is it likely to go lower to sweep out short-term lows for sell side liquidity or sell stops? Or is it likely to go down to rebalance an old imbalance or a fair value gap below market price? That is the number one question that I have before I sit down in front of my charts. That's what I'm looking for. What is the current market narrative? What is it likely to be doing right now? I don't care about patterns in price action. I don't care about anything harmonic. I'm not looking for any kind of Elliott waves. I'm not looking for any kind of ratio idea. I'm not looking for anything that you can attribute to a retail mindset. Nothing except for those two questions. Is it likely to go up for stops or go down for stops? Or is it going to go higher to rebalance or lower to rebalance? Now, how do I arrive at that idea? Is it going to go higher or is it going to go lower? Because that kind of leans on that question I told you many times. If there's one question I get asked the most, it's teach me bias. In other words, you want to know, where's the market going next? And that's good. That's the next draw on liquidity. But the daily range will not always submit to that bullish or bearish, right from the opening go higher or right from the opening go lower. Sometimes you'll have consolidation intraday, and you may have been trying to take a trade that was based on an idea that you came to that would be bullish. And maybe it did give you an opportunity to be in a trade that was profitable for a period of time, but you held on to it thinking the daily range was going to keep on going higher, and it turned on you. These ideas I'm going to teach you in this lecture here will help you identify the likelihood that your idea is probably been proven inaccurate, but you have to be receptive to the clues that price is giving you. That's the number one reason why I abandoned indicators. And if you have anything on the charts that cover up candles or draw your attention to something that you're putting on the chart, and I call that, facetiously lipstick, okay? That's what this chart is showing here. It's this lipstick. It's me communicating how I am internalizing this price structure. This fractal in price, I'm looking at it with this idea. Now, I'm looking at it in a matter of seconds. I come to this conclusion. I'm looking at the highs, and I'm looking at the relationships between each swing high, each swing low, and I'm coming to a conclusion, studying one swing at a time. And I'm going to come up with the idea that it's likely to go lower because that daily chart, I called it in front of all of you. I outlined it, told you where it was going to go. So that way we understand one another. I'm teaching something that I already proved before the fact. So it's not like me coming back to this area here, because if you haven't watched the videos prior to this, say you just found this YouTube channel and you're watching this one, it sounds like the typical guy that comes on YouTube and says, here's something that happened, and I can sound and look and appear smart because it's already happened and I have no real risk in being wrong. I told you it was going to go lower from here, and it did. Now I'm going to take you inside that price action and outline what it is that I look for, what it is that I looked for at the time, and how I felt confident it was going to go lower. Okay. So right away, we know that price is traded up to the high end of that fair value gap. And again, this level here is that daily chart. Let me go back up one chart. That's this level here. Okay, it's on this candle, that low. And the low of the fair value gap is this candle's high. Dropping down into the hourly chart, that's the high end of the fair value gap. This is the low end of the fair value gap. Again, on an hourly chart. So that way we have our bearings. So when the market traded up into and just above that fair value gap high, this red level here, once it started to break down and go lower, it traded back down into this candlestick's high. So we're trading back inside this range, and we're range bound. Since I am expecting the daily chart to be the parent of this price structure, all minor lower time frame swings are going to be subordinate to it. And what does that mean? This now is a long-term high. I do not expect this high to be broken to the upside. Should it be broken to the upside, that means that my daily analysis, expecting this level here to hold price and to be a factor in the algorithm repricing and going lower at a later time, if it goes above that, then I'm probably wrong in my analysis. So therefore I demand more information by studying more price action and sitting on my hands. Or if I have a trade on, it means that I have to admit that I'm wrong, and the stop out that may occur is just me managing risk. It's a losing transaction. It does not mean your model is flawed. It does not mean that you're a failed trader. It just means that that transaction was not a profitable one, and it's just a cost of doing business. But as long as price remains below this high, my idea is this is a long-term high, because it's framed on what? A higher time frame resistance level, if we're going to talk in terms of retail ideas, so that way we can understand something in a simplistic manner, but we'll build on the ideas that will help move you away from simple support resistance ideas. So this long-term high should remain intact. In other words, price should not go higher than that. We trade down to the discount level of the low end of that fair value gap, and it starts to find support, rallies back up, trades near the high but does not take that out. Very important. Once it starts to break down and consolidate, in here, retail ideas will see a lot of trust in the idea that's potentially a bull flag. I love seeing those patterns because I like to fade them. So that's a false bull flag. And when we see price break down like this and then rally back up, every single time, this is important, this is the part where you start writing down these details. Every single time price rebalances an imbalance, like we have this candle's low, this candle's high, we have that one single candle passing down like that. Once that rebalances by going up here, that swing high from this high, and this high, that's a swing high right there. I immediately label that in my mind, not on my chart, because I don't want anything distracting me. If I have these things written on my chart at the time, it's going to be a distraction to me. But the way I'm internalizing it, and you'll see what I mean as I go through this lecture, every rebalance of an old imbalance, that swing that's created at that moment, I immediately label that in my mind as an intermediate term high, or in this case, as we came back down and filled in this by dropping down here, that's an intermediate term low. What does that mean? What's the significance of that? Typically, what you'll see is an intermediate term low has a higher short-term low to the right of it, and a higher short-term low to the left of it. This intermediate-term low forms by rebalancing, but it has a higher short-term high here, but then the market trades over here off of this short-term low. It rallies up, but it fails. It fails in here. We're going to anticipate that failure. Whereas if you're looking at this low, high, higher low, failed, higher high, higher low. So what's forming here? A pennant or a triangle pattern, right? How do you know which side's going to break out? That was one of the questions I had all the time as a developing student back in the 90s. 1992, 1993, I was buying every book I could get my hands on. And I got the book, the John Murphy Technical Analysis of the Financial Markets book, which is the retail trader's Bible. Okay, that book is so useful in terms of just reading it and knowing what not to do, because that's what the 90% crowd follows when they look at price action. Still to this day, because it's always regurgitated in some way, shape, or form. Someone's teaching that same idea, uptrending trend lines, which are so subjective. How do you know what swing low to attach for a trend line? There's lots of swing lows in here. How do you draw it? It's all subjective. So you have to have a way to reduce it down to, I hate to say it like this, but it really is no better way of saying it, but you have to break it down into a science. We don't do technical analysis. We do technical science. Okay, you have to be able to relate to certain things, weigh out and measure what these factors are within price action, which is not based on hypothetical guesswork or some kind of a harmonic animal pattern, which to me makes no sense. You have to look at the relationship to price action and the relationship of how it behaves. What is it indicating? What is it showing? The market has traded higher and then consolidated. We failed to go above this important high back here. That's a long-term high. Then we have an intermediate-term high. Why? Why is this an intermediate-term high? Because we have a short-term high here and a short-term high here. So between two short-term highs, the highest high between those, that's an intermediate-term high. But the main takeaway for your notes so far is anytime a imbalance, like this big candle up, is rebalanced, that becomes an intermediate-term low. Just as well on the opposite end, this down move here, that's a fair value gap. As soon as it rebalances there, that's what I classify as an intermediate-term high. Now here's where we take a huge step forward. So if we have a imbalance that's rebalanced and we have an intermediate-term high, shouldn't an intermediate-term high have a lower short-term high to the right of it and a lower short-term high to the left of it? Yes. Mr. Williams says so in his book also. What I discovered in my own study, no one taught this to me, okay? I kind of pioneered this idea. See a lot of these Instagram guys out there saying they pioneered something in the last 2 years of trading. The idea of a intermediate-term high not being higher than the short-term high to the left of it or the short-term high to the right of it. In other words, it's going lower. This, an ideal scenario, should be this high should be above both short-term highs. But it's not. It's not. So what is it doing? It's only rebalancing this. And where is it likely to go? Well, if you're thinking in terms of a pennant or a triangle pattern, it's indicating to me, as soon as this candle starts to go up like this candle and this candle. Why not this candle too? Well, this candle only has this low here. This candle is an up close, but this starts the last two up close candles right before this move down. This is important because we're going to look inside this shaded area and how we can use highly precise ideas within this order block. I'm anticipating this run up with these candles forming an order block where everyone else is teaching the idea of The last up close candle before the down move. That is not my order block. That is not my order block. So you need to stop teaching that because it's not accurate. Call it something else, but don't call it order block. This movement here, these two green candles that are going up, I'm watching these as they form live with the expectation, because this imbalance has been rebalanced here, this swing high is an intermediate term high. I do not expect this high to be taken out. So I'm already forecasting and anticipating a failed price swing in here. Every time this green candles are forming, I'm looking at that as a bearish order block. So from the beginning at that candle's low, I'm looking in time on lower time frame charts. Lower than what? Well, this is a 1 hour chart. So what's the time frame below that? I dropped to a 15-minute time frame. Now, before I get any further, just know that the range between this long-term high and this long-term low, that range is going to be used for targeting purposes, and I'll get into that in a moment. But these up-close candles, from the hourly perspective, that's the range for my hourly order block. Inside that range, I can be hunting fair value gaps. Light bulb. I don't need to see the market trade down below the last highest up close candle. I don't need that because I understand what I'm looking for inside market structure. Actual market structure, not just higher high, higher low. I'm looking at the underpinnings of the marketplace and I'm examining what is it doing high to high, low to low, within a higher time frame premise. Remember the premise was we were going to go up to this upper level here, rebalance, and then eventually trade lower, down below sell side liquidity. In this fractal, I'm using this one here just to illustrate the idea. So in other words, up here, it's going to make a short pattern, something bearish to get short on. Then work towards going down to that low. Now clearly you can see it here. It does so nicely. But I want to take you into this price action right here. Before I zoom in, look closely. What do you see? Pause the video. I'm not pausing the video, ICT. And you can't make me. Alright? Right in here, you can see a small little imbalance. This one single candle like that, right there. That's the same thing that was occurring in this move here on the hourly chart that gets rebalanced there. Here, we have a smaller version of it. That is a fractal. That's something that repeats on a smaller or higher time frame that's similar in its formation. It won't be identical, but it's closely related to the general idea. If it trades back to this candle's high, don't worry, I'll zoom in a moment. That's your entry right there. That's aggressive, and I don't have a problem being aggressive if I know what I'm looking for. But there's also an imbalance in here, and it rebalances that right there. See that? Now, once we establish the market structure on that hourly chart, I'm not going down into the lower time frames below it and marking out all the swing highs and swing lows either. That's overkill. I just need to know what I'm looking for on the time frame I'm trading on. The logic is based on that daily chart that it's going up into this imbalance to go lower. The hourly chart frames my trade. It gives me what I'm looking for to start hunting entry techniques. Now the 15-minute time frame, that's the bellwether. This is where it's going to give me the actual get in, get out. But I might not like the risk parameters that's required on this time frame. So I can go down into the lower time frames. Should price go lower and break lower, I'm looking at that short-term low here and that intermediate-term low there. If we have a short-term low taken out and an intermediate-term low taken out, or just an intermediate-term low taken out, then we can go back to the previous long-term high, long-term low. Now, a long-term high and long-term low is generally going to be linked to a higher time frame daily chart. That might be a price range. It might be a high to a short-term low. In this case, I'm framing the idea and logic around that fair value gap that I outlined in front of all of you, saying it's likely to go up there, rebalance, and then go lower and take out that old daily low. There's lots of ways you can frame your trade, but you have to have something directly linked to that daily chart, because the daily chart, that's exactly what institutions are working off of. That's exactly what banks are working off of. That's where the money is. That's where your bias is going to be determined. That's going to be what makes or breaks your trend continuation, that daily chart. So the majority of your time and study should be on determining where that daily chart's going over the next day or two or a week. But you try not to forecast longer than a week. Not that you can't. I'm not suggesting that anyone can't do that. I'm just saying, if as a developing student, you want to keep your perspective limited to a 5-day time horizon. And don't be upset if you don't have the entire weekly range forecasted correctly. That's not important right now. You're growing. You're trying to learn how to do this, and it's highly technical. No one gets it overnight. It took me 6 years. But it pays off if you stick with it. So if we have a break below an in-return low, then we have what? A significant break in market structure. This is something that's more significant just simply than going into a chart saying, okay, well, it took out a short-term low, there it is. See how much more detailed this is? What this tells me is, then I can start using this range, high and low, and start getting projections down. I can get a measurement of measuring this high to this low and start replicating that going down. And it'll give me price targets. They're generic price targets. If you don't want to use that targeting method, this long-term low to intermediate-term high, if price breaks below here, as it does here, you can simply take your Fibonacci, anchor it to the highest high, down to the lowest low, and this is what you would get here. Why am I using that? Why am I not using this here to here? Because this return back up, this is where all of this move starts right there. This is just the beginning of the framework. This is where the swing begins on the decline. Follow what I'm saying? I'll say it again. This high and this low, that's your framework. The retracement that fails, that starts the decline, begins here at that intermediate term high. So if you anchor your fib to the intermediate term high down to that low, which is a long-term low, the projection is -1.5 standard deviation, and there's your low. How much lower than this can it go? That's one way of determining it. Now I know what you're asking. What is your fib settings, ICT? There's my fib settings. Okay. I don't toggle everything because I don't need all the lines, but I'm looking at measurements like this with logic behind it. It's not just me randomly going in there, because I get a lot of questions. When I was on Baby Pips, I got lots of emails all the time, and people would post in the forum, why are you anchoring your fib to that swing high and not in that swing high and not this swing high? This is what I never taught. This is what I'm showing you today. This is advanced market structure. This is not something you're going to find in books. Mr. Williams, I'm sure, doesn't even know it like this. He's rather simplistic in the way he does things. That's the only thing I've really gleaned from him. He's a legend, don't get me wrong, but he does things rather simplistic. But because of my background is computer programming and computer science, and I have obsessive compulsive disorder, I need to know why things do what they do. And I need to know everything. Now, I don't know everything, but my pursuit of knowing everything led me to look at markets like this and internalize what the algorithms are doing, because there has to be a rhyme and reason, right? Like, to suggest the idea that these markets are operating under an algorithm and they're going up and down based on an AI, artificial intelligence, is controlling this. It's not your buying and selling pressure. I've said this many times before, but if that is true, and let's suspend your disbelief if you don't believe there's an algorithm, just for the sake of this conversation, let's just say for a moment that you do subscribe to the idea. If there's an algorithm, that means it must follow some form of logic. And how does it reference how far to go up and how far to go down? It cannot see your stop. It doesn't see Michael's stop. It doesn't see Renee's stop. It doesn't see Juan's stop. It doesn't see Brian, Larry. That's outside of its capability. But it knows where people will have their stops based on these ideas. Short-term high, short-term low. Intermediate-term high, intermediate-term low. Long-term low, long-term high. And where the imbalances are. Now, I already know right now, at this moment, right now, your heads are spinning. You're probably sitting here looking at, man, this is crazy. How did he come up with this? And how the hell am I going to use it? Exactly. You're going to take time learning this. Line upon line, precept upon precept, here a little, there a little. It takes time to do this, okay? But I got requested to teach market structure, and this is my interpretation of market structure because I'm leaning on algorithmic principles that are in the marketplace that can't be taught to you, but I'm creating a language so that way you can see it visually in your chart and you can measure and reference certain things, not exactly like the algorithm does, but very, very close to what it's doing, which in my mind doesn't really step on anybody's toes now, does it? So if we're looking at this little shaded area here, I want to zoom in now and get down to the heart of this teaching. This is the same 15-minute time frame. I'm just zooming in a little bit more. This is an aggressive entry for going short. Now, that hourly chart was showing those two candles going up. In the 15-minute time frame, it's obviously more candles. So in this up-close candle series of 1, 2, 3, 4, 5 candles, in that range, if I get a fair value gap form with a breakdown like this, notice I don't need a swing low broken. Notice that? On the model I'm teaching you, you have to look for what? The short-term low being broken. That's your market structure shift. Then you see price go up into that imbalance, and then you can go short. Or vice versa when you're going bullish. If you understand market structure with this perception, looking at it from a higher time frame and anticipating a breakdown, but then starting to classify each imbalance and swing high and swing low, intermediate term highs and lows are formed at the rebalancing of an imbalance. Everything I already said in the video. Okay, I'm just reiterating. If the intermediate term high is not higher than two short-term highs, that is telling you that the market is very weak. And the algorithm is tipping its hand to those people that are looking at it like this. Who would be looking at it like this? Smart money traders. Someone that's not looking at a chart with harmonic ideas, nothing Elliott wave. They don't even look at support and resistance. That's not a factor. That's not a factor at all. When bank traders sit down, they're not looking at support and resistance. They care less about a trend line. They don't care about moving averages crossing over. None of that stuff. They're looking at imbalance, rebalance, and liquidity. That is it. That's it. That's all they're doing. Now, framing that within the context of Forex, they would be utilizing the fundamental idea of interest rate differentials, which I'll talk a little bit about. Not in this lesson, but I said we go into Forex. But right now, we're teaching price through this medium in index futures. But this stuff works in Forex. Period. Okay? There's no reason to question whether if it's just only going to work in this. It works in all markets. This is your aggressive entry. You don't need a swing low being broken because you have the idea based on market structure suggesting that this is exceedingly weak. If it's exceedingly weak, that means the next short-term high How do I know it's going to be a short-term high? I don't know because I'm studying the up-close candles, because that's going to be an order block later on. Now, everybody else knows how to look at these candles after it goes below it and comes back up and bumps the bottom of that right there. So the bottom of that rectangle, that's the classic ICT bearish order block. The advanced interpretation of an order block would be using market structure like this, which is unconventional, but you start seeing the imbalances inside the order block when you're already expecting it to sell off. See, this intermediate term high, I already know that this rebalance here classifies this, in my mind, as an intermediate term high. That means it should not trade above that high. Just like this short-term high and this short-term high did not trade above this intermediate term high. Why is this an intermediate term high when it didn't even rebalance anything? Didn't think I'd get to that question, did you? He's reading my mind. Here's a long-term high. Here's a swing high over here, and a swing high over here. See that? Long-term high, right? Intermediate term high, short-term high, short-term high, or if you want to use this one, I'm using this one, not classifying this one because this is energetic, it moves lower. You could have easily had a short-term high marker there, but I'm using this one because it has that run lower to rebalance. The intermediate term high has a lower short-term high to the left of it and a lower short-term high to the right of it. So intermediate term highs, there's two classifications. It is a short-term high that has a lower short-term high to the left of it and a lower short-term high to the right of it. Or, and this is the main one here, it trades back up to rebalance an imbalance. That immediately becomes an intermediate term high. Now, the usefulness of that is, if we're bearish and it rebalances like this, the next short-term high should be lower than that intermediate term high. If it trades higher than that, then your trade idea is probably flawed. Don't force that trade again. Wait for market structure to get back in sync with what you're expecting, something bearish. That's how you keep from blowing your account or forcing your will in the marketplace. Now let's go back into the order block. Inside these candles as it's going up, I'm looking at lower time frame charts, and this is a 15-minute time frame. We see it break down. It doesn't take any short-term low out, but it's inside these up-close candles, which is an hourly order block of 2 candles each. The imbalance trades up into it. That's your aggressive sell. Your stock could be right above that high. Classic low risk, high confirmation short entry is the classic return back to an order block after it trade down below it. Here's your little gap. Here. Trade into it. There's your short. Where's your stop? Above this candle's high. There you go. Now, you can go down into the charts deeper with your 5, 4, 3, 2, and 1 narrowing down to a smallest time frame. You can see that the last 2 candles here, wait for the turn, inside the order block. The order block is the shaded pink box. But these last 2 candles here, with the gap, that low is exactly to the quarter point as that candle's high right there. Don't take my word for it. Go into your charts and you'll see that is exactly the perfect delivery to that candle's low. Why am I pointing to that candle? Because the order block is one consecutive series of up-close candles. It's not the last candle before the down move. You can tell where these folks learned, what lessons I taught from, and where they parroted from. But order block theory is much more than just simply the last up-close candle before the down move or the last down-close candle before the up move. That's not it. This is it. You have the up-close candles together here with the imbalance inside of a larger order block within a bearish market structure because we have an intermediate term high here. Then this run up is going to fail to go back above this high. Now, I know some of you are like, this is too much. Like how am I going to be able to go into the chart and be able to do this? You're not going to right away. But you need to go back to your data and your charts and start breaking them down and classifying them like this. You have the benefit of hindsight. That's how I began to trust it, because I would go through old data and start breaking them down and looking for these things right here. That's how I bridged what I learned about how the algorithm prices and books price. And then I made a language within price charts that communicates very closely what it's doing. This is the language that I've created for all of you to understand what it is I'm trying to interpret to you that have never seen this before. The imbalance here, it goes over a little bit, that's okay, but inside this range in here, more specifically, the order block, the hourly right here, that's where your fill would be, or aiming with your limit order. And the heat on the trade would be on this candle's movement there. But your stop will be above here. But you're aiming for a very large downside objective. So the risk from entering here at the bottom of the hourly bearish order block, which is again represented by the bottom of that rectangle here, you're entering there. The heat or the drawdown in the trade is limited to just that candle. But your stop has to be here, and you're expanding lower for a target that's many times over what your risk is. Dropping down to a 4-minute chart, here's that same order block from the 5-minute perspective. It's a little skewed now because we're looking at 4 minutes. Each candle's 4 minutes in duration. Market trades up into that, hits it perfectly. Not this linked to anything on the 4-minute chart, but it's linked again to that 5-minute chart. Hits it right there beautifully, trades lower, comes right back up, trades into the top end, that fair value gap on the higher time frame before we start dropping down. We have a little bit of movement above it, and that's okay, because this market is very volatile right now. You can't demand the markets to always deliver with this level of precision. Sometimes you get this little coloring outside the lines, and that's okay. That's a matter of experience and time studying it and doing it. You anticipate a certain measure of imperfection and still submitting yourself to the idea that just because it went above that level doesn't mean it broke it and it's going to keep going higher. It's likely to do that, and if it does, don't freak out. Then the market trades lower and reaches for those targets. Now, what I want you to think about is when you see these patterns for entry, now tonight I taught you how to look at market structure from an advanced perspective. I already know some of you are going to be very confused by this lesson, and I understand your confusion, but that confusion is reduced by you going in and looking at price data and start studying it and looking at it. The idea is this: when you see an imbalance get rebalanced, the high formed as it rebalances, that high should not be violated by price going higher than that if you're bearish. If you blend that with institutional order flow, what is institutional order flow? When you're bearish, all of your up close candles should keep price from going higher than them. What does that mean? We have an imbalance here. The market trades up into the bullish candles that are on the 5-minute chart. We're on a 4-minute chart. That's that red level here. Let me go back up to say that you know. That's this one here. This is a down close candle right there. These are the last two up close candles before the displacement here and imbalance. The market trades back up into that right there. There's your bearish order block. That's aggressive, but if you know what you're looking for, that's very, very fun to do that. On the 4-minute chart, there's that same return back to that 5-minute bearish order block. Watch what happens. Market breaks lower, so we have up close candle and up close candles. The market trades higher, yes, but does it overtake this up close candle? No, it just trades back up into it a little bit, but doesn't go above it. Wow, that's important, because if it doesn't overtake these up close candles here or here, it doesn't even need to get to these because it hasn't even overcome this one. So it acts as real resistance. That's institutional order flow. Your market, when it breaks again from the consolidation in here, all of these up close candles never get reached into again here at all. But notice what we've got over here. We have up close candles. The market leaves it. Then it comes right back up. Does it overtake these up close candles? No. So it's going to remain heavy. So in short, I've taught you tonight to look at the markets from a market structure perspective by breaking down the price swings, labeling them, specifically an imbalance that's rebalanced. That intermediate term high or low should not be violated. That's a key high or a key low. That sets the stage for a market move that should unfold and deliver to a higher time frame objective. In this case, as we outlined in the beginning, I showed you last week and the week before that we were looking for weakness in NASDAQ to take out its daily low. If you combine that logic with market structure and the imbalance rebalance becomes intermediate term highs and lows, those key highs and lows, with them not being violated, if they are violated, that means your idea is wrong. And you cancel the idea and you don't try to go in and force it again and overtrade and blow your account. While the market is moving in your favor, you're going to continue to trust that move and hold on to your trade, because if you're bearish, up close candles should keep price below it for them if it's multiple up close candles. They're speed bumps. They may come back up and touch them and act as a what? Bearish order block. But you do not want to see them traded above if you're bearish. And vice versa. If you're bullish, when price is moving higher, generally the candles will be predominantly green in my case, because I'm looking at green candles when it's going higher. Whatever your candle color is on your platform, predominantly there's going to be more up close candles when it's bullish. But down close candles should support price. If it trades back down to them, it's going to act as a support structure for an order block. So I've given you two main components to market structure and institutional order flow. How to know when the move is still good and not be afraid. And how do you know when the move is likely to be dynamic? And how do you know when the idea is probably flawed and your interpretation or your analysis is wrong? If that intermediate term high or low is broken after your trade idea becomes possible, if that intermediate term high is broken and you're bearish, then you got to move to the sidelines and don't go in again. Wait for more setups in the future. It may be in the same trading session, or it may be in the same trading day, or it may require you to trade in the following week. You just can't force it. I taught you institutional order flow, which is, again, I've already mentioned this in the previous lessons, where we're bullish and we're expecting a price swing higher. Generally, there is not a lot of down close candles in that price swing higher. But those down close candles should support price should it trade back down into them and not see them overlapped, in other words, going down below it. If it does, it's only permissible if there's a short-term low in close proximity to it, and it's then likely to just go down and take out some sell stops if it's bullish, and then reaccumulate and go higher. If there is no swing low, there would be no swing low with sell side below it, so there's nothing to concern yourself with. Just look for down close candles to support price higher. So in other words, price swings that are bullish, down close candles are your support. In price swings that are bearish, up close candles are your resistance. Now, if you blend these ideas together, you get a perspective on.
We're going to be looking at an amplification of order block theory. We're specifically dealing with the mitigation block. Okay, when we look at mitigation blocks, what we're looking for is a condition in the marketplace where the market has given clear indications that it wants to break down or move higher in a step ladder formation. In other words, like selling rallies or buying declines. Buying declines in bullish markets and selling rallies in a bear market. Okay, when we look at the marketplace and we frame price action in the form of resistance levels and support levels, or anticipated bearish institutional reference points and anticipated bullish institutional reference points, we have to have a context in the marketplace behind our viewpoints. Are we looking at the market that has a bullish scenario, or are we looking for a market that has a bearish scenario? In this example, we're going to look at a market that has a bearish example. When we're looking at a market that is moving up into a potential bearish resistance level, market typically will move up and move into a old high. It could be an old low. It could be a bearish order block. It could be a breaker that we'll learn more about. It could be a multitude of things that would lead your opinion into the realm of resistance. Okay, but without going into great detail what that may be, there's multiple opportunities to frame that idea of being resistance. If a resistance level is expected, or you anticipate some selling pressure at a particular level, as is indicated here, what we do is we wait for price to indicate a confirmation that there are willing sellers up there. If the market does show a repricing and it rallies one more time up to it, what we're going to be doing is monitoring, does the market have a willingness to want to break down? And eventually the market will show signs that it does in fact want to break lower. Now if you look at this specific pattern here, this is what is referred to as an M pattern. Why? Because it looks like a giant M. Okay, well, when you have this pattern here, it's a failure swing with a confirmation break in market structure. That low right here is what you're going to be utilizing to frame the context of the market structure shift. So when that shift in market structure is seen here with a break below that old low, that gives us confirmation that the market does in fact have participants on a large scale willing to drive prices lower. And that's what we need as small traders. We have to have the willingness to have the smart money indicate their cards, if you will. In other words, show their hand. Do they want to send prices lower, or do they want to send prices higher? In this case, this is indicating that the market does in fact have confirmation that it wants to go lower. So what we do is we look at this range from that short-term low up to that short-term high. Inside that range, there has been buyers. But the problem is now those buyers are underwater. This short-term rally in price highlights a specific institutional reference point known as the mitigation block. Once price posts a market structure shift lower, your attention as the trader moves to this specific low in price, right there. Inside that low, what we're going to be focusing on is the last down candle, because the last down candle is where the buying took place right before that little short-term rally up. Since price broke below that low at a subsequent later time, which is really there's no rule as to how long it takes before that low is violated. We just note it, and when it's broken, it's seen as a short-term support level that's given way with a bearish context behind it. So when we see that, we're seeing the evidence is that there are smart money entities behind the marketplace driving price lower. Now, at first glance, it looks like, well, this is a missed opportunity. But no, what we do is we focus on this low, because that last down candle will give us a bearish level to sell into. When price drives back up into that old short-term low we just referenced, there's going to be 3 reference points that you need to be aware of. The market structure shift is seen here. We're retracing back into it right there. What 3 points are used at this moment? You have point A, point B, and point C. When price action returns to the point of A reference, the long positions taken from A to B price swing will have an opportunity to liquidate or mitigate their losses that were occurred during the price move from B to C. Now this can result in new lower price swings to C for retesting, or a significantly lower price move into a support level that's under the market price. In short, this is an opportunity to sell whatever particular market or asset class this is. As the market breaks lower, let's say you look at the chart and this is what you see here. It does not mean that you've missed an opportunity. It just means that now you have a new opportunity that's unfolding. Do the longs in here, in that short-term low to that short-term high, do they need to be mitigated? We don't know for certain, but if we do have a belief that price is going to be moving lower longer term, that there's an unrealized lower support level or sell-side liquidity that has not been tapped into yet, we could be viewing this short-term rally in here as an opportunity for a new selling opportunity. We have another market structure shift. So where's our focus? Given what was explained in the previous example, where's our focus right now as a trader? Why are we looking at a specific level, and what are we anticipating? That low right there. Inside that low, the last down candle, that's what we're going to be looking for price to reach back up into. If it does that, we can be a seller at that moment. As price drives back above it, into that low, we're watching price trade into that last down candle right before it had that short-term rally before. Right at that moment here, we're looking to go short. As price hits that last down candle in the previous short-term low. Where's your focus at this moment? We're anticipating price to move down from this point here, which is giving us a short opportunity to run the liquidity out below this short-term low here, and potentially as low as our higher time frame support level. As price hits our longer-term support level, or anticipated bullish institutional reference point, which could be an old high, it could be an old low, it could be a bullish order block, many opportunities to frame that idea, but whatever that is that forms your idea for support, this is the objective that you'd be reaching for. As price hits that level, we would be collapsing our trade and moving to the sidelines waiting for new developments. When we have this in the marketplace, what we're seeing is the classic support broken turns resistance. Every time price moves back to an old low, actually happening is it's referred to as buyer's remorse. The buyers at the previous short-term low that saw a short-term pop in their favor, then eventually saw the market break below that low they bought at. When price gets back to that level, they're remorseful for buying it, so they bail. But on an institutional level, the smart money understands these short-term fluctuations, and they can drive price on a short-term basis higher or lower through manipulation. So if they're going to manipulate price on the short term by having large orders come in and push and bully market pricing around, they're going to want to liquidate those positions, because just like anyone else, they don't want to incur losses. So this gives them the opportunity to mitigate those losses. Premium price highs are bought by less informed traders and sold by smart money. Which are you going to be grouped in? Okay, folks, we're going to look at a quick example. And I'm going to draw your attention to a liquidity void in here. And there's equilibrium of that liquidity void, body to body end, or is the open and close. And we're going to highlight that reference point here, so halfway point of this equilibrium. The idea is we broke this high back here. We're expecting continuation on the upside. Market trades higher, but it shows a breakdown in here. Okay. In here, this failure swing right there, we're going to be looking at this low. And I'm just going to drop horizontal lines in on the respective lows. And this will be a new mitigation block when we drop down into the lower time frames. Market should sell off there. It sells off, breaks this low here, so the last down candle on this move here is there. So once price trades back up, that's a sell right in here. It shoots it, just overshoots it by a little bit, but nonetheless it breaks lower right here. So now our attention is on this low. Every rally that sees lower prices needs to be mitigated right here. So if we trade back up to that low, that's a sell. Right there is a sell. We're going to be aiming for a move back below this low, ultimately down into our equilibrium of our liquidity void right here. Low comes in at 111.48, 111.48. Here's a short-term low, hits it, trades lower, trades back up into the last down candle, hits it, overshoots a little bit, but it's inside the body of the candle, which is what a mitigation block represents. Price trades down below the last down candle here, and we have another lower low here, so we can adjust that one to that low there, right there. Price hits that. Objective is going to be break below this low, sells off, goes through it, and ultimately goes down into our mean threshold of the liquidity void. So a couple different things shown in here as an overlap study on mitigation. Let's take a look at a 30-minute chart on the same price action. Here's a mean threshold of the liquidity void. Last down candle, right for the up move. Price hits it, sell it right there. This is a mitigation block. Everything that was used to drive price higher, once it's traded below here, it's underwater. They're going to want to mitigate those losses at that candle, sell short. This last down candle here is violated here. If price trades back up to it here, we can be a seller. The whole entire candle is used, not just the bottom, but we can be a seller down here. So it could be a short seller at 112.62, and our stop has to be somewhere above the down candle in here. Okay, so that high on this candle comes in at 112.89, so it needs to be above that in the form of a stop. So we could be seeing just a little bit of drawdown in here, about 20 pips or so, but never getting much above this down candle. Price trades lower, violates a very convincing break down here. Last down candle, the low, trades up. Now again, notice the body of the candle is not violated. This is hallmark characteristics of a mitigation block. Price trades up into it. We're expecting prices below this low now, and then ultimately reaches down into our mean threshold of the liquidity void. Then ultimately, I'll give you a view of what took place. Price eventually started to move back up. So hopefully this has helped you with mitigation blocks. We will come back, and we're going to be continuing our discussion on reinforcing order block theory. This teaching, we're going to talk about propulsion blocks. And a propulsion block is a candle or bar that is previously traded down into a down candle or bullish order block and takes over the role of price support for higher price movement. In this example here, okay, in this crude diagram, we have a down candle which shows price willingness to move higher, and then we have a new down close candle that trades right back into it, seen here. That candle becomes a propulsion candle, what makes it propulsion is that it's already dropped back down into an order block that's already predisposed to go higher. Then we created another higher order block that touches the initial one. That new higher level bullish order block or down closed candle will be highly sensitive. It should never see the mean threshold break half of the body's height or the middle of the range of that candle's body. That mean threshold should not give way. The sensitivity is going to be very much more amplified when it trades back down into the high, but we are willing to allow it to still trade down in the middle of the range or mean threshold, but it most likely it will never do that. It just trades down into the high of the candle and it immediately explodes. It may go pip or two below the high of that particular down candle, which we're naming as a propulsion block. The market will show a sudden and violent movement away from that down candle. That's a propulsion candle. Let's take a look at it in price action to get a better feel for what it looks like. Okay, first let's take a look at a bullish propulsion candle. Okay, you can see price has moved from a low here, and we're on the buy side of the curve, and the market has several down candles in here. So we would take this as one full bearish candle because it's consecutively 3 down candles. So the bullish order block is framed like this. So we have equilibrium down here. Price trades all the way down to this level here but falls short of equilibrium. So we have a level at which price could reasonably trade down into, but it doesn't do it here. So price trades lower here and then rallies through its own 3 consecutive down candles. So this is an order block as well, together, all 3 candles. And then we have this candle right here. Okay, see this down candle? It's trading into these down candles together. So this is all one bullish order block because it's all down price movement, reaching for a level to buy, and then price moves through. This candle here trades through the highest of the down candles. So that confirms this is a bullish order block. The very next candle trades higher, and the next candle opens and trades down into this candle here. When this candle creates the down close and closes, this becomes a propulsion candle. What makes it a propulsion candle is that we are trading another down candle into a previous down candle when the underlying context is bullish. The powerful nature to a propulsion candle is you don't ever really see a mean threshold violation on it. So if you get an opportunity to see it trade back down into, as it does here, this candle opens, trades down into it right there. The open comes in at 133.45. The low on this candle comes in at 133.45. Goes right to that candle. So that's a bullish entry here with a propulsion candle. And again, all it is a down closed candle that trades down into a previous down closed candle, or in this case, this is a 15-minute time frame. I don't have a way of showing you a 45-minute chart here, but it's the same price action that we've seen here. The down candle trades into this order block that would be bullish, and then we see price trade higher and then come right back down into this candle here. This is the propulsion candle. That means we should see immediate responsiveness on bullish price movement higher off this down candle should it trade back down into it again. Here's the clue. If we break the mean threshold of that type of candle where it's already traded down into a previous order block, it's bullish. If this loses its mean threshold, chances are it's probably not a good trade. So that means you can have a really ultra tight stop loss on your long entry, or you can have immediate feedback that you're on the wrong side of the marketplace and you probably are better off either going to the sidelines or many times looking for a reversal to go short. Okay, we're going to look at an example of a bearish propulsion candle. Okay, we're going to frame it around a higher bearish order block. It's this candle right here. Price trades up into it here, breaks down. So now we're going to add another level of order block theory. We have this last up candle that's the bearish order block here, referencing this one as well. So now watch what happens. We have price movement lower, then we trade right back to this order block right here. This candle becomes the propulsion candle right there, this one. So now we can cut that candle in half right here. Boom, hits it right there, main threshold, trades immediately lower. This is a sell entry on the propulsion candle that's bearish. We could be a seller there, and we can also use a entry at a later time where it trades right back into this candle's low, where it trades right here, hits it, responsiveness immediately moves lower. So look at the responsiveness after it trades into this candle. You have to see it break below this candle's low, which it does here. Okay, it's already showing a willingness to not want to go above that main threshold here, but it breaks down, then trades right back up into this candle's low. It doesn't need to go up to the body. It's the low of the candle on the propulsion candle. It's going to be very, very sensitive. Hits it, immediate, quick responsiveness as you would expect. That's why I gave you the name, the propulsion candle, because it propels price quickly and suddenly, and it gives you immediate feedback. Very little drawdown, immediate price responsiveness. That's exactly what we're looking for as short-term traders. So hopefully this has been insightful to you guys. We're going to give more information as we go along in the months, and when we start mapping out outlines and setups, we'll see exactly when to anticipate propulsion candles. Until next time, I wish you good luck and good trading.